Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Boom. We are back. Focus Compounding Podcast. Andrew Kuhn sitting alongside Geoff Gannon. Jeff, how's it going over there?
It's going great, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody else. If you are on Twitter, you should be following me at Focused Compound. And if you like receiving memos from Jeffrey, go to focuscompounding.com, and on the homepage, enter in your email, and that will put you on our list to get a bunch of free content from us. Also, if you do like free content, there is a free section on our website that you can check out. All you need to input is your email, and then that will allow you to have access to a bunch of free content, and free is good.
Yeah, you get a weekly series of write-ups on specific stocks.
That's
basically.
right.
Well, you get the first 1,000 words of each write-up.
And even better, if you want to become a premium member,
then you get the whole write-up. Yeah.
Sign up. Focus Compounding. Use the podcast promo code, which is podcast. That'll take $10 off of the price. It brings it from 60 to 50, and then you'll get access to a bunch of Jeff's writings and other people's as well. So today we're going to be going over some more questions. We're just getting tons of questions flooded in with us, and I think it's good, like I always say, because it allows us to sort of talk about what's on our listeners' minds. Mm-hmm. So we'll do that. So the first question says, if you had to make a list, and this is from someone named Liam, he said, if you had to make a list, what are your favorite financial/psychology books which positively impacted your investment decisions?
Okay.
So I got one actually sitting right here.
Yeah.
Right? You just asked me. And this is, you ever heard of this book? It's called The Essays of Warren Buffett, Lessons for Corporate America. You ever heard of that?
I have, yeah.
I'm sure you have. That's a great book.
Yeah, that is a good one.
I would say, obviously all of Warren's writings are good to read, even going back in like the old partnership days.
Yeah.
Those are incredible. And then obviously all the Berkshire letters are great. What I have on my computer is I have them all compiled together in one PDF, and then you just Control F and you could search through like a bunch of like whatever topic you want. And you could like just type in, for example, intrinsic value, and then you'll just, kind of get to filter through a bunch of things that he's talked about, intrinsic value. But no, I would say that's probably a good book that a lot of people could benefit from. It's one of the books that I think everybody should reread every single year. And then the other book I would say for me is Poor Charlie's Almanac.
Okay, yeah.
That's a great book on not so much investing. I mean, there's investing stuff in there, but I think it's more on like how to think about life and how to approach life, and the mental models and everything, and which obviously covers a lot of the psychology part of investing and just kind of going at it every single day.
Yeah, I would say there's a huge number of things that are sort of like about Buffett. There's like a whole industry and that sort of thing. And I'll just mention two books that I think are surprisingly good. I don't agree with everything in them, but and I don't know how much they really tell you about Buffett's actual approach that specifically, but they have interesting sort of strategies that you could learn from. And so one is Buffettology, the original one.
It's a good book. Yeah.
That's good. And just in like showing you how to invest in a business based on looking at what you think will be earning in 10 years, which is a really good exercise. So that's good. And I think it's the Warren Buffett way. Hagstrom, yeah.
That's a good one.
So he also did Warren Buffett Portfolio or something like that.
I really like that book because that was kind of one of the only books, I think, I'm sure there's other out there, but that I've read where he actually went back and valued the businesses at the time that Warren was purchasing them. So I guess it kind of like was just a good case study in a way on like all these different companies. But no, I agree with you. I thought that was good. Yeah,
in terms of what actually I think had an effect on my investing and stuff, the ones for me that did were Security Analysis, You Can Be a Stock Market Genius, and also Phil Fisher's.
Security Analysis was so boring to me.
Yeah.
I obviously I like Phil Fisher's books.
Yeah.
You Could Be a Stock Market Genius, which everyone listening that knows us knows that we love that book. But yeah, Security Analysis was so boring to me.
Did you read The Intelligent Investor?
I did. Yeah.
Was that better or still?
I mean, I read it because you have to, but I didn't particularly like. it wasn't like, wow, I can't put this book down. It was like, wow, I want to, but I'm going to continue plowing through so I can put this book down and be done.
Yeah, I've heard that from a lot of people. For me, The Intelligent Investor and Security Analysis. I read Security Analysis first, The Intelligent Investor second. One weekend when I was like 16, I read those two.
Mm-hmm.
And no, I couldn't put it down, Security Analysis.
Really?
I thought it was a great book.
Two types of people.
And it, you know, I don't know if it's the most helpful to most people.
Yeah.
That's part of the problem is that I think You Can Be a Stock Market Genius would probably be the one that would be most helpful to people. But actually, I think, you know, it's not like the writers are great that wrote the book or anything, and it's a little simplistic and stuff. But really, if someone who doesn't know anything about Warren Buffett or something did read Buffettology, I think it really does reinforce the actual investments that he's made these last like 40 years or so. It's not necessarily what he did in the partnership years, but from, you know, Washington Post on, it really covers the kind of thing that he does. And really brings home the idea that he's investing things where he's valuing it based on what it'll be in 10 years.
Sure.
And that means that like 90% of the stocks out there, he can't really value, you know, because he can't look ahead those 10 years. And it's good at just like showing that you need that past consistency in earnings and things like that. Although I believe, if I remember Security Analysis correctly, it also has something like that where Graham talks about earning power and the central tendency of the earnings, and he shows that you don't just take a past average of the last 10 years and stuff. So, you know, Security Analysis, I think, is the most has the most in it, is the most interesting for you to dissect yourself.
I also like biographies as well, and just books on business in general, right?
Yeah.
Even though it's not exactly an investing book, but like the Airbnb story I thought was pretty, I like just reading how like businesses came to be, and obviously you could apply that to investing, and it all is interrelated in one way. I'm looking at my bookshelf over there, Quality of Earnings, Financial Shenanigans. Those were good books. But yeah, and what about you for like, I guess the psychological side of things?
Psychological,
because I always talk about that stuff, and I think that interests me a lot more than interests you. And
that might be true.
Yeah. Have you? I mean, are there any books on that side that you enjoy or that you've read?
Well, Charlie Munger has mentioned what is it, Influence, a lot.
Yep.
Yeah, and that author came out with another book after that, pretty recently, right? Was that Persuasion? What was that?
Oh, I'm not sure actually.
Oh yeah, I think it's called Persuasion. He has a book that's more recent than that. A lot of people have read that and kind of. Yeah, I mean, I can think of a lot of behavioral finance type things that I've read. Some are pretty good. I think I kind of prefer the ones like that. The ones that I like a lot that a lot of people don't like are books like John Neff wrote a book about the investments that he made, and sort of almost a journal of the kind of investments he made as a mutual fund manager. There's Always Something to Do is one that I liked a lot that way, because they're just really good in combining people's actual investment decisions with like the emotional aspects of it and stuff, of like, well, we were buying this when everyone else hated it, and this is why, and that sort of thing. You mentioned something about the biographies, which I forgot to mention, which is maybe even more than things like Security Analysis. I would recommend, there's a couple chapters in The Snowball.
That's my favorite book, for sure.
Yeah, and there's a certain section of it, which I highly recommend, which is basically the section from the time that Buffett goes to Columbia to learn from Graham to the time when he actually takes over Berkshire, the in-between time there, his partnership years and his personal investment part. And that has a lot of information that isn't really in a lot of other places, sort of almost like case studies. That's really good.
Yeah, no, I would completely agree with you on that. I actually have that on my Audible, and I've listened to it probably like 4 times. Yeah. Every time I need some inspiration, I just go back and listen to the early partnership days.
Yeah. That's the best part for people to learn from for the investing thing. I mean, that book is much more than that. Almost half that book is not investing stuff, I'd say. But yeah.
No, I would definitely agree with that. So I think actually a good segue, as I talk about inspiration, as you were talking about the 2 books that you read when you were 16, somebody asked us a question, said, I would be interested if you guys could talk a little bit about the path that you each took to get to this place in your careers. He said, managing accounts yourselves. And one piece of advice you'd give to someone who hopes to be in your position in 5 years.
Okay. The one piece of advice that I would give is the one piece of advice, I guess, although most people probably already be doing this, is you have to invest all your money yourself now. You can't like learn now and then you're going to invest later or something. That's a weird thing to say, but a lot of people email me and stuff that they want to get there, but they're not doing that part of it yet. They're just reading a lot of books and learning and stuff, and you can't do that.
And that was a little hole I fell into.
Was it? Yeah.
Yeah, I would agree. And I think if you can, I guess for me, if I had to give any sort of advice, is I'm pretty sure, and I don't know if it's gonna make you feel good, but no one would be listening to me right now if like you and I weren't partners, or that you and I didn't meet. So if you could find someone that, it could be like a good mentor towards you, or someone you could learn from, because obviously I've learned so much from you. That is great, and obviously will speed up the process as well. What else?
Well, in terms of personal, how we got there and stuff, and that sort of thing. I've said many times before, I got involved in investing when I was like 14. I read a lot of things probably around 16 or something, and then I dropped out of college around 19, I guess, and started blogging and doing a podcast and things like that.
Yeah. You were the OG when it came to investing online. That's right.
So, yeah, I think the most important thing is to, the most important thing is to be doing the work yourself, which means that you're looking for, with the accounts that we manage, we specifically look for overlooked stocks. But even if that wasn't the case, that's really what you need to be doing is, to a certain extent, tuning out the market and what people are talking about and things like that, and just going off and studying some particular company. Now, if you want that company to be Facebook, that's fine, but you have to go and kind of go into seclusion and come up with your own ideas about Facebook for a while. I would say specializing is great. Like if you want to be the best restaurant investor there is, go learn about every single restaurant that there is and become like that's your niche, right? Ours just happens to be overlooked stocks, right? Where we spend a lot of our time in, but like whatever interests you, whether it's oil or technology or software or consumer, whatever it is, just own that space where you're just very familiar with it, and just kind of stick in there, kind of like the Tom Watson. Yeah, just be very smart in a couple or in a small area. Yeah, be the best at it. Yeah, that's definitely true, and it's just something that becomes a habit of what you're doing, of looking at stocks all the time. The thing I guess that's hard to explain about what's successful and what isn't successful in terms of my own investments is that the thing that's always really hard to get across to people is that the best investments took 5 minutes to decide on. And that makes people think like it's not a lot of work or something, but you're spending all this time on all these things that aren't 5-minute decisions, and that's preparing you for the time when you find something that is so obvious.
You're just taking pitch after pitch after pitch until something does come, and then you're able to sort of seize it.
And you're learning so much about these companies. So you spend a huge amount of time reading about possibilities and then not doing anything, and then once in a while you do something. And that's the tough part about it. That way, because it's hard to distinguish that from luck or something in terms of like were you lucky that you found this one idea or whatever. In terms of like your career and things like that, I wrote a lot of things online. If you can write, then definitely do that. If you can't, then get someone to do a podcast with or something like that. Do something where it's where you can get discussing things with other people and bring other people into that conversation through email and stuff with them, meet other people that way. There are probably some ways to do it offline too.
And there's so many ways, I would say, to connect with people because of like the internet, whether that's Twitter or email or your blog. My advice would be to him, because he asked if he wants to do that in 5 years, right? Start to build a brand, if you will, or just yourself in a way where to the point where you have a following and people are reading your material and stuff, and you could do that by Twitter, right? So if you have a blog, push it out through Twitter, connect with people, and let the network effects take off, and then start a podcast. Just do whatever really to get your name out there.
Yeah, I'd say today Twitter is what blogs were when I started out. That makes a lot of sense to do it on Twitter. But what you're going to have to do is come up with your own investing ideas and then share them with other people, basically, if you want to get people to want to hire you and stuff. I know a few people who started writing blogs and stuff, and they're mostly working as analysts now, not portfolio managers, but still, that's how they got into that business and things like that.
Cool. Best resource on asset valuation?
I'm going to say I don't have any idea on that one. Do you have any idea?
Best resource, like if like a theoretical thing. There's a couple books. The Valuation books by McKinsey. What is that? I'm looking over there.
Does McKinsey have one?
Yeah, I think it's something. Yeah, I think it's them. That's a good book. Other than that, I think it's just really, reading case studies on Value Investors Club. Go to Value Investors Club. You could look at best performers, and you could filter through on that and just read past case studies of stocks that worked out or even ones that didn't work out.
Yeah, the one that I probably rely on the most is when one company takes over another company.
So, like, because it lays out the valuation, or
yeah,
what?
on the SEC, there'll be a fairness opinion put in there, and the fairness opinion will use comparable transactions for total acquisitions of companies and also what they trade at and stuff, and I use that all the time. So that'll be post-merger stuff, or it'll be post the announcement of the merger. It may very well be filed after the merger, actually, but that it'll have all the details and stuff in it. But if you know that a company is going to be bought out or something, so let's say, using big examples of companies and stuff, you're following like Occidental, Anadarko stuff and things like that. Well, if that deal ever closes, whoever buys them, there will eventually be something put out by the company that's acquired, and that will have a fairness opinion and things like that. After the board recommends that their shareholders approve it and things like that, they'll hire someone. And Goldman Sachs or Morgan Stanley or whatever will put out this opinion saying why shareholders should vote for it, and that will include all the sorts of past oil deals and stuff of comparable companies the last 10 years or so, and they'll use that sort of thing for their fairness opinion. So I'd recommend that.
I'd agree with that. I was taking a sip of my Diet Coke. Okay. So this one guy, he's been tweeting me a bunch.
Okay.
And whatever I tweet, he says, he always says, yeah, but have you heard of Beyond Meat? Like that new company that came. So
yes, I have heard of Beyond Meat.
So I tweeted, call for questions or whatever. And he tweeted me, he's like, do I even have to say it? And then I said, yes. And he said, have you ever heard of Beyond Meat, and when can clients expect to see BYND shares in their accounts? The fact that he's asking us probably means it's not an overlooked stock, so never.
Yeah, it's not. Actually, in the recently Buffett and
I didn't think it was funny, though.
And Munger were taking questions, and I think they said that was it probably I forget if it was Uber or Lyft, the IPO that they were asking about. But they said, it's not a decision on the company, really. It's just we don't buy any IPOs.
Yeah.
I've never bought an IPO, and I don't know. Well, it is interesting to follow IPOs, and a lot of them, the stranger they get, the more it tells you about the kind of market that we're in and stuff like that. So.
Sure. That's funny. What are the strongest moats you see in today's economy? And a few examples on companies would be appreciated.
Yeah, this is probably one of the most common questions people ask it's a little difficult to answer. I can tell you, so years ago I wrote up a bunch of stocks that I thought, I was working at Guru Focus at the time, and I thought that it was a computer screen, so I had to take things off the screen. I didn't have the choice of being able to pick things myself. So I thought almost all the stocks on the screen were pretty expensive, so I wouldn't really recommend them to people. So what I did is I just picked the companies I thought had the widest moats. And so that's going back to, I don't remember if it was 2012 or sometime around then. And the stocks I picked, I think, were like Copart, Waters, Exponent, and Ball. And actually Ball was written up recently on our site. So just in terms of companies, I'd say those are four that have some of the highest, the widest moats now. And there's different reasons for it in each case. You can find a lot of companies like that. And I'm sure there's economic theory that'll explain why those companies have wide moats. But the thing with moats is what you really want to look for is something where there's a relationship with a customer. Sometimes it's a formal relationship. Sometimes it's that they drink Coke every day, and so that frequency becomes the same thing as a formal relationship. And there's a fear the customer has, an uncertainty about going with anyone else, and that's what you want. So what doesn't have a moat is a washing machine.
So you're talking about like brands?
It can be brands, but it doesn't have to be brands. So we own a stock, Computer Services. Computer Services is in core processing.
I was actually thinking computer services when I read the question. Okay. Yeah, I was.
So they're here, to be honest, we don't want to get into all the stocks we own and don't own and stuff, but here's the deal. We own, there's one stock in the managed accounts, which is a pure commodity company. No moat or anything. All of the others, I assume, have moats. Otherwise, I wouldn't buy them. Mm-hmm. Generally, I want to buy companies with moats in the sense of in the Buffettology sense. If I want to be able to, when I value a company, generally I'm buying it with what would be the return if I held it for 10 years.
Yep,
that's what I'm looking at it. We don't tend to hold them for 10 years, but that's how I'm looking at them. So, we have three companies that have moats in my view. And those companies tend to have a few things in common. One, they have between 90 and 100% customer retention. Two, they don't lower their price each year. So their price might stay the same. It might increase. Sometimes unfortunately, and for many of these companies, they price it off of volume. So volume can go down in a given year. But what they don't do is tell you that the thing they were charging you $1 for last year, $1 a pound or whatever, is now 90 cents a pound. That doesn't happen. And they tend not to lose their customers. So they invest a lot in specific customers and those relationships, and they have very high retention rates. So anyway, computer services, if you go read American Banker, they had a couple articles about computer services at times and core processors generally. And one quote that stood out, which is just sort of in general what a lot of people say about the industry, is they said that switching core processors is like having open heart surgery in the perspective of the bank that's doing it. And they don't want to do it. And that's an advantage. That's one reason why Buffett bought IBM, which didn't turn out well for him. But he thought that people wouldn't switch away from IBM. They'd be afraid, these big, giant corporations, to use another company for of their IT stuff. So, that's the reason. So what I was going to say about the moat thing is an example of an industry in which it's hard to have a moat would be washing machines. Mm-hmm. Because the problem with it is most people, they might be right, they might not be wrong, but most people who own a Whirlpool washing machine believe that LG is good enough that they're not going to regret buying it. They're not really afraid of that possibility. The same thing as in flat screen TVs or something. I might think Sony is better than Samsung, but I'm not terribly afraid that one of them is going to fall apart tomorrow.
Sure.
And the other one's going to last me for 10 years. When we get into other kinds of things, that is what happens. And so people are very, economists talk about switching costs, but that's not really it. What you need to look for is situations in which someone would be afraid of switching to some newcomer just because there's a lower price or something. I mean, the company I've said many times I think has the widest moat is BWX Technologies, which makes nuclear reactors for the Navy. And
has long-term contracts.
And stuff. But also just in general, if we start up a new business to build a nuclear reactor for the Navy and we said that we can do it for less than BWX does, there would be a lot of doubt about that. They just supplying a lower price to someone that they've never used before means that they're a lot less likely to do that.
Sure.
Now, the government buys a lot of all sorts of little supplies and things by just buying from whoever is on their approved vendor list that has the lowest bid. That's not what that industry is. So there are concerns about that. So, engineering companies have that. Anything where there's a great deal of concern about switching to someone else. And even to the point of irrational fear about switching to someone else. And that can be brands. If you like a particular brand, then why switch it up to something else?
Sure.
I think it's better to look at it from that negative perspective of whether you would trust someone else. So a lot of times it is trust and things like that. But it's fear of switching, I would say, is the biggest one.
Cool. Next question. The gentleman says, yes, I do have a question. When will we see more YouTube videos? I can only watch Taylor Swift's new single so many times. I need some new content.
Well, you're the only one who know I want to see new YouTube.
What are we aiming for? Twice a week.
Yeah.
Is what we're expecting. And, I'm kind of exploring the whole YouTube format, and I've had a lot of... So if you are interested, subscribe to Focus Compounding on YouTube. Okay. And we've kind of tossed around a couple ideas about maybe doing some sort of value investors course or something along those lines. Not necessarily sure if we're going to pursue it. We may, but as of right now, I'm just doing like a mental models course on there and just really just pick a mental model and just kind of talk about it. So I think there's 2 videos up there now, and then I'm going to aim for 2 new videos a week. Mm-hmm. And my goal is to kind of keep it shorter. Yeah. And at least it was at first because I wanted to embed it in Twitter. I think they only allow you to have like 2 minutes or 2 minutes and 50 seconds, really? Something like that. But I just couldn't get it under that time frame, so I just did it to YouTube. So maybe now I'll do more like 2 to 5. I'm not sure yet. But the goal is actually to pump out 2 a week, and Jeff's keeping me accountable. So that's where we're going. 2 a week is what we're aiming for.
And we're expecting a lot on like mental models and stuff?
Yeah, mental models, different topics, things I just really find interesting that I kind of want to just ramble on about and talk about. But yeah, as of right now, it's just mental models.
That'd be good. We don't cover a lot of that stuff on the podcast.
Yeah, and I think it's just doing different formats of content, which is, we're just kind of exploring a bunch of different stuff. And I've been recording it on my iPhone, and I have this little stand here that I hook up my iPhone to, and maybe I got to get a different camera, but because I actually recorded a video the other day and it just wouldn't render in like HD, so it just looked all weird. But yeah, two a week is what you can expect from me. And if you want to follow us on YouTube, that's Focused Compounding, but I'll also post it through Twitter as well.
Yeah. Okay.
Cool.
Good.
Next question. I know Geoff bought Japanese net nets. Any other countries you are looking for those types of opportunities right now?
Not for net nets, no. I mean, there are other countries that have net nets, but I would say Japan is as good a place as any to look for net nets. I've heard some people say Korea is good. I don't think it's as easy sometimes for some investors to invest in Korea as it is in Japan. I'm looking at lots of different countries, but generally not for net nets. We had someone on the podcast who covers a lot of things in Japan, and if you're interested in Japan specifically, you should definitely go to his website. Do you have that for them, what his website is?
I do not know.
Okay. But
I'll post in the show notes.
Post in the show notes, good. And then,
Kenko?
I can spell it for them if they want.
Yeah, go for it.
KENKYO investing.com.
There you go.
But put in the show notes anyway, so they don't have to.
Yeah.
But that's a really good one because that's someone who's speaks Japanese and English and is writing up things in English about Japanese companies. But yeah, NetNet's Japan is the best place. Japan just has a huge number of stocks and has had a very long period of underperformance as an economy. So I would say if you're really interested in NetNets, make Japan the place that you focus on, definitely. But yeah, I'm looking at other countries and things. I think some people know that I've been looking particularly at the UK a lot recently. But I don't think that the whole Brexit thing has really caused that much of a decline in their stock market or anything. It's in the headlines all the time, but it hasn't caused necessarily enough to get me more interested in that. But there are some companies there that are probably cheap because of some concerns about that.
How long did you hold your NetNets for when you invested in them?
Most only a couple of years.
Really?
2 years average or something. Some were taken out within a year, so I'm not even sure.
When you mean taken out, what do you mean? Like acquired?
Acquired. Two were acquired in the first year. So that probably brings the average down below 2 years. There were some I held longer than that, but it's possible that the average wasn't even 2 years when you factor in those two. Yeah, because I only bought 6. So, I mean, we could get into that in terms of the diversification. I figured that 6, taking about 50%, it wasn't quite 50% of the portfolio, but close to 50% of the portfolio divided by 6 is enough diversification. Even though I don't know anything really about the companies other than the statistics.
Yeah, so you're looking at the accounting and stuff, right?
Yeah. So, I mean, I had business descriptions into what industry they were in. But
were you sort of agnostic towards which industry you went to, or how did you think about that?
No, I picked industries that based on how those industries perform in the rest of the world.
Yeah.
So I picked industries that were the most predictable. That's all that I did. So if a company said it was a wholesale, a wholesale marketer of fish or something, I didn't buy it. And if it said that it was in paint or electrical engineering or something, I did buy it just because I know those from other countries.
Got it. What about and the way you thought about it too was they had to be profitable, right?
I'd have 10 straight years of profits.
10 straight years.
And that included the financial crisis.
Oh, wow.
Yeah. Operating profits. It couldn't be from their bond portfolio, yeah.
Got it.
And they had to be selling below net cash.
Hard to lose there, right?
Yeah. No, none of them lost.
I was going to say all 6,
profit.
right?
Yeah, they all turned to profit. But, and the portfolio did fine. And if you can find that, that's great. There's less opportunity of that I've seen in Japan lately, but there's still net nets in Japan, and you can still find them, and some are perfectly good. Because his website, Kenko Investing, is behind a paywall and stuff. I won't talk about everything, but there is a company that's a big supplier tied in with a huge Japanese company that you know well and stuff, and it seems perfectly normal performer. And it may not be, a Buffett type business in terms of high returns on capital and things like that, but it's a pretty consistent earning business and closely tied to a giant Japanese company you know well, and yet it basically can sell for being a net. Pays dividend and stuff like that. So there are things like that in Japan that you'll find. It's more of a Ben Graham type approach. I would imagine today Ben Graham would be in Japan.
Really?
Yeah, it might be in some other countries too, if you could, be in Korea and places like that, but definitely Japan. I would imagine of all the countries out there, the one Graham would buy the most in is Japan. Yeah.
Cool. Well, that is our last question for this episode. I want to thank everybody so much for asking those questions. Like I always do say, if you have a question you want to get answered on the show, even if we may record a few weeks later than when you ask it, DM me on Twitter or just send me a message, whatever, or tweet to me or whatever. I always kind of compile them together and then we go over them on the show. If you do want to reach out to Mr. Geoff Gannon, his email is gannoninvesting@gmail.com, and mine is info@focusedcompounding.com. Join our mailing list. Follow me on Twitter. Promote, right? And on YouTube, right?
Yeah, our mailing list is stock write-ups. That's what you get from it. Yeah.
But if anything, the one thing that will warm our hearts is if you go onto iTunes, the podcast app, and rate and review. That a lot of people have been doing that, and that's been helping us out. Like I always say, it's how the algorithms work. So we really appreciate it. We hope everybody has a great week. We'll see you in the next podcast. Take care.
Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.